9 minutes. It's good, right?
Back on, that's the question. Yes, it seems I am. Thank you very much, Scott. Fascinating stuff. Probably the first time I have seen AI explained using photographs of sausage dogs, which I very much approve of, so thank you for that. Now, up next, the private equity industry provides important capital benefits for entrepreneurs, of course. However, the debate has arisen. Is private equity helping or hurting innovation? For that, please give a warm welcome to my esteemed colleague, Marie Mawad, joined by Tim Hentschel, Chief Executive Officer of HotelPlanner.com, to discuss the effect private equity has on innovation.
Thanks for joining us, Tim.
Thanks for having me.
So you co-founded Hotel Planner in 2003, and it's a 100% employee-owned company, which is now a kind of a rare feat in the tech industry. You've been doing acquisitions in travel tech for a decade now, but you're seeing a change of trend that you say is threatening innovation, and I understand you have a bone to pick with private equity investors in how they're affecting innovation in the tech space.
Well, I wouldn't know if it's a bone, but being as old as I am, I've been seeing bubbles for decades, right? You had the savings and loans junk bond bubble of the 80s, and then you had the dot-com bubble of the 90s, and then in the noughties we had the subprime bubble, and I believe we're in our fourth bubble now, and it's the private equity bank bubble. If we look at what went public and unicorns this year, they're trading at a price to sales ratio of 3.5. But if you want to talk to any private equity bank portfolio holder, they're buying companies right now at 5x to 10x of their revenues. So if they don't have the public market as an exit, where is their exit? Well, it has to be one of the big tech monopolies that are out there. But those companies now know that they don't have the public market to compete with, so they're not giving those kind of multiples either. In fact, there seems to be a trend to push back towards EBITDA. At 20 times EBITDA is some of the highest ratios that I've heard from the big companies that's in our space in travel tech. So everything's changing right now, and it's changing very rapidly, and it's going to have an effect on how startups, get their funding.
So what are those valuations, that bubble that we're seeing? How does that have anything to do with innovation, and how is it affecting innovation?
Well, the problem is we've got to get a return to the consumer. Startups need to look at getting their value from customers and going back to profitability, obviously, because the days of just taking your business plan and shopping it, and that means whatever's hot in the private equity market, and you see a lot of lemmings in that space. So if whatever's hot and Blackstone or Sequoia puts a ton of money into it, then you've got all the mid-tier banks that want to copy that investment, so they'll find their own company that does something similar, and all of a sudden you have 20 startups all doing exactly the same thing because they're chasing the investment, they're not really chasing the customer. When really that market that they're chasing is probably not even that big. I mean, we've seen so many niches, and really the reason that these companies get to the revenue growth they have is only because they have a 40% loss every year on their revenues. Well, if you're buying customers, it's not that hard to get 50, 100% top line growth if you're buying customers at a loss. And I think everybody in this room is smart enough to know who I'm referring to as some of the big unicorns that have that model right now that who knows if that's sustainable.
So how much of the kind of experimental, try it, see if you can change the world vision that entrepreneurs have had in tech for the past 20 years, how much of that is able to survive this kind of valuation and bubbly context that we have right now?
I mean, the only ones that will survive are the ones that can become profitable. The only ones that can survive are the ones that can win customers, real customers that actually like your product, want to buy it, at fair market value. Not the ones that just want to do it because you've subsidized it with private equity funds. I mean, if you just look at the money that last year went into private equity unicorns of $287 billion, and their revenues of all the unicorns combined was under 150 billion. obviously there's more money in raising money than there is actually making money. And that's when the model's broken. So I think we need to get back to a real economy, that's all.
So you've done your fair share of acquisitions over the years. How different is it when a full employee-owned company goes out and buys a smaller one than when private equity firm comes in and puts money behind a startup?
Well, because we're organic growth and we have to be profitable, I have to buy on a multiple of EBITDA. I have to invest and then get my money back. So if I'm a tech company and the internet's constantly changing, I'm taking a big risk just going 5 times EBITDA, 10 times EBITDA, because who knows what in 3-4 years the innovation curve is going to look like and what's valuable on the internet. I can't look at that company and say for sure that EBITDA is going to be sustainable at that point past 5 years with the innovation curve. So, for investors like me that are fundamental investors, it's based on value, there's not a lot out there because you're competing against private equity money that it just gets bigger and bigger every year, and they have less and less places to put it. So all that's happening is there's a spike in the values of these companies to these astronomical valuations that don't have no real fundamentals, and that's the definition of a bubble. So until the bubble bursts, traditional investors are kind of locked out.
And to what extent are we seeing entrepreneurs now thinking about how they're going to fund their companies rather than how they're going to get to customers or come up with something really new? To what extent is funding becoming the kind of only thing that entrepreneurs are obsessed with, and why is that such a bad thing?
Well, I would say it's a bad thing if you want to be a pure entrepreneur that can really enforce their vision on what their product's going to be. So, when we started the company in 2003, from day one, we wanted to make sure we were profitable as soon as possible, give up as little equity as possible to make sure that we could, own our own vision of what the future would look like. Now, of course, we did raise a little money. We bought those investors out and gave those shares to our employees because, again, we wanted all the employees that were working on the product to have a say in what the product was going to be. So the only way to truly do that, to make sure if you're an entrepreneur that got into business to bring something to market that was your exact vision, the only way to purely do that is to make sure you still own the majority of equity in your company. I think that's an important mission that all entrepreneurs, real entrepreneurs, not paper entrepreneurs that just want to go out there and shop a resume to a bunch of banks, really want to get back to the fundamentals, sell something to a customer, make a profit, and then control your own future. I think I'm the only one in the world actually saying that right now. I'm probably the only organic growth tech travel company out there too. So, we'll see what happens, but there's always a correction. I mean, there's been 4 decades of proof that every bubble eventually bursts.
So expanding on what you just said, what advice can you give to entrepreneurs on going back to the basics, basically, and refining their soul, I guess, their entrepreneur's soul within the current context?
Well, it used to be that if you want to be a good entrepreneur, you take $1 and you make it into $1.10, not $1.90. Now with the private equity market, it's a lot of people taking $1 and making it into 60 cents. And then somehow that's success, which is hilarious because the math doesn't work. But if you go back to the fundamentals and you go to making $1 into $1.10, yeah, a lot of things will change very rapidly.
And looking forward in the next 2-3 years, you said you see the bubble bursting. Do you think that's going to give way to more consolidation? Do you think some players will disappear, including in the travel tech space? How's that going to play out?
There's definitely going to be some disappearance. I mean, of just the unicorns, we have 311 out there and growing. If they can't take it to the public markets anymore for the reasons we just talked about, the multiples are not there, and especially if there's volatility in the market like it is now, and there's a lot of talk that a strong market's going to become a bear market, then you're forced to try to sell your company to the big tech companies that are out there, and they're not paying the multiples of revenues anymore. So some of those will just have to disappear if they can't become break even or profitable, because if the private equity market can't continue to raise hundreds of billions of dollars every year to subsidize these companies, there's no choice. I mean, that's just economics, right? They can't pay their bills. They can't keep the lights on. and that will be, what will happen. There'll definitely be a pruning. I'd be surprised if 10% end up viable companies in the next 5 years.
10%, so that's like 9
It's hard
and 10.
when you're losing, 40 cents on the dollar. That's a hard, gap to make up. That's really hard.
So we're going to see the kind of dot-com bubble kind of carnage happen again.
It's inevitable. If we get out of 2020 without a huge bubble burst, I'll be shocked. I mean, history has proven me right, and the fundamentals of this market show that there's going to be a bubble pop.
Okay.
My prediction, by 2020, bubble pop.
Okay, that's a pretty dark forecast. If I bring it back to innovation, because we are on the innovation stage, what do you see as kind of new trends popping up in travel tech that are going to be disrupting the industry in the coming years?
Well, I know what the private equity bank's like. I mean, there's a company called Oyo, and there's a huge amount of companies like them that are now buying apartments and low-cost motels by simply offering them a renovation. And so they'll own the bedding and the drapes in the room to basically bring something that's substandard up to a minimal standard. And then they become a somewhat franchisee of this, taking 3 times franchisor margins, and that's very popular right now. The money that's being poured into it, we'll see if it's sustainable. We're talking about the very low end of the market, so these are rooms that trade at $25, $30 a night, and it's very popular as the new thing that's hot. But of course, 30% on $25, that's not a lot of money to be able to build an entire multi-billion-dollar company on. So we'll see if there's enough market there for them. But basically, they're becoming this ultimate franchisors that's taking 3 times, 4 times more margin than Marriott or Hilton would. So it's the new hot thing in our market in travel tech.
And what kind of innovation would you like to see coming to the market, or what are you going to be looking for in acquisitions as our closing thoughts?
Well, I'd like to see more automation in the group travel space. I mean, that's what we specialize in, and so that's what we're going to continue to do.
Okay, thanks very much.
Thank you so much.
Enjoy your lunch, everyone.